I'm going to call on Carmen now to come up and be gentle with us, please, Carmen. 12.92 on the dollar, 20.32 on the pound. Be gentle.
Great, thanks. So hard to be upbeat and tell you it's the end of the world with a smile on my face. At least I don't have to do the presentation in Afrikaans. That's sometimes asked of me because my surname is Nel. So obviously the topic I was given sort of was to discuss what's the prospect of SA falling into junk status. So I know you're a mixed audience, so basically credit rating agencies rate sovereigns. If you BBB or above, then you rated investment grade, which is a good thing. If you BB or below, then you are sub-investment grade, and then the sort of market jargon refers to it as junk. So obviously fear shouldn't then paralyze us, but create opportunity. So through the presentation, I hope to sort of educate you on the major issues, and then also highlight where the opportunities are. So what is important is that, yes, it is a big threat, but obviously the economy still has some time in which to actually address its shortcomings. Okay, so this is just the agenda quite briefly. You can see that I'm going to actually be quite thorough in explaining sort of how we got here in terms of sort of at the edge of potential junk status, how we stack up, what's the importance in terms of the ratings agencies and how they look at us, also what the flags are to monitor and how we can change things, and if things do really go pear-shaped, what the risk is for the economy. And we've also done some analysis on historical episodes where countries have lost investment grade ratings and how they've actually fared. So sort of what does it take to then get back into investment grade. So just in terms of the history, so the chart on your left-hand side, we basically show the progression of developed markets, so that's DM, and then emerging market ratings over the recent years. So you can see generally, South Africa, which is the orange line, has very closely tracked the improvement in terms of the emerging market credit ratings. So we haven't been particularly unique in that sense, but where there has been a divergence is with our recent negative ratings developments. So you can see there we've actually diverged a bit, which then makes us stand out. You can also see that there was, in the wake of the global financial crisis, a decline in developed market rating scores, and that's because, if you recall, we had the Eurozone debt crisis, so you had the likes of Greece, Portugal, Spain, etc. being downgraded quite sharply. There was some reprieve, but more recently, again, with the Greece sovereign debt crisis, you've seen renewed downward pressure on ratings. So on average, if you look at the global sovereign rating scale, on average it's a BBB, so we actually shouldn't be too hard on ourselves, we're in line with the average. And around 55% of global sovereigns are rated in investment grade, but that's down from about 59% before the global crisis. In terms of the South African ratings history, which you can see on the right-hand side, we've taken a lot longer in terms of improving the credit rating than we have now in terms of falling on the or embarking on a downward trend. So South Africa reached investment grade in 2000. That was just after a period of notable fiscal consolidation and with the introduction of inflation targeting. So two big ticks for the government, which then enabled the government to reach BBB. It took us about, on average, 6 years, if you look at the three main ratings agencies, to actually get that investment grade rating. We're just 2.5 years in terms of actually working on our sub-investment grade rating. So again, very important. It's a lot quicker and easier to lose your investment grade status than it is actually to gain it. And a country that has been in the news a lot over the last sort of month, 2 months, is Brazil. So they took around 13 years to get investment grade status, and they're really at risk of losing it now just because of a populist election last year. So just then the history. So very basic chart. You can see it's the budget balanced GDP ratio, so what government basically saves or does not save every year. That's the blue line versus the terms of trade. So terms of trade is basically South Africa's export prices relative to our import prices. So when the line's moving up, we're doing relatively well in both cases. When both lines are moving downwards, we're doing badly or under pressure. So you can see the first section was sort of late 90s into the early 2000s. That's what we sort of call active consolidation. And that's because you can see terms of trade was basically flat. It was sort of at the peak of the dot-com bubble, so it wasn't a particularly good time for the SA economy, yet the government managed to actually reduce its budget deficit and actually started to pay down some of its debt. So that's why we say it's active. The government actually went out to improve its fiscal position. Following on from that, we go into a period which we call passive consolidation, so where you still saw an improvement in your budget balance, but that was because a lot of it was brought about by the commodity price boom. So the government could almost just sit back, not do much because the revenues rolled in. The consumer was doing well, business was doing well, mines were doing well, so profitability was high, tax take was high, so it was able to take in a lot of tax receipts and still was able to actually up expenditure. So real expenditure growth ran around 3-4%. Low double digits in nominal terms, and recall that's at a time when global interest rates were falling, local interest rates were falling, again strong rand leading to interest rate cuts, and then what it allowed the government to do was actually to save on its debt or its financing costs and actually roll out the welfare net. So it was all around a very good time, everybody was winning. Then obviously came the global financial crisis in 2008, 2009. So the SA government had the benefit that it sat with a budget surplus, which it could then use to address the recession. So rightly so, it went into what the jargon's called contra-cyclical fiscal policy. So it offset the weakness in the private sector by supporting the economy via jobs, expenditure, and not hiking tax rates, etc. So it allowed its revenues to fall. And that is usually the right thing to do from a fiscal policy perspective in a crunch time. However, once growth started to rebound in 2010, so you can see we call it fiscal slippage, the government continued to hire more workers, it continued to pay people excess real wage gains, so it was settling wages in the civil service around 9-10%, which translates into around 3% real wage gains, which has now put significant pressure on the fiscal position. And the fiscal slippage is what the ratings agencies are really focusing on at the moment. So now we know we started the downgrade trend in early 2012. So when you speak to people, and certainly in certain segments of government, you need to convince them that there is actually a cost to downgrades. Because if there's not a cost, then I wouldn't be talking to you today, and we wouldn't have done the analysis because nobody would have cared. But we think there is a cost. So we go back to see, okay, where has that cost been reflected? And then later on in the presentation, we'll see potentially where it could be reflected should we actually move into sub-investment grade status. So if you look on your left-hand side, so that's basically the SA equity market relative to the broad EM equity index. So we try and gauge, has the equity market faced a penalty because of the downgrades? And you can basically see when the line's moving up, SA outperforms, when the line's moving down, SA underperforms. On balance, there's basically been no, we've actually managed to outperform at times, underperform now, but since 2012, really no penalty being given to SA equities. Part of it is due to the fact that a lot of our large counters listed on the JSE would either be seen as rand hedges, they gain a lot of their revenues from offshore, and therefore they have benefited from the weak rand. But overall, even in the domestic counters, looking at the bank's performances, some of the domestic retailers, it's not obvious that investment into local equities has faced a penalty. On the right-hand side, similarly, if you look at bond yields, so just the reverse, when the line's rising, SA underperforms, and when the line's falling, SA outperforms. SA bonds have actually outperformed the broader EM peer group. So the most obvious place you would expect the sovereign credit rating or the discount or premium associated with the sovereign credit rating to reflect would be in the bond market, and we haven't really paid the penalty there. Where we have paid the penalty is in the exchange rate. So yes, we are at 13 versus the dollar, over 20 rand versus sterling, so no one's going to London anytime soon, but yeah, you can clearly see that since 2012, which now 2012 coincided with the peak in commodity prices, It coincided with significant socio-political tensions locally with the Marikana event, and since then the rand has broadly underperformed. More recently, you could say it's outperformed, but really it's only other emerging markets, for example, the Brazilian real, because of their ratings issues, the ruble in Russia, because of its problems, have almost caught up with the rand, and therefore we look okay, but again, we look okay relative to a bad bunch, which also highlights the issue about not being happy with sub-investment grade, because it may lead to complacency. So you may be the best country in a bad pile, which is never a good benchmark. And then finally, so this is, okay, so CDS is your credit default swap, so just market jargon, basically for an insurance premium on a sovereign. So when it's wide, it's costly insurance, in other words, you're a dodgy credit, and when it's low, it's cheaper insurance, which means you are better quality credit. But you can basically see, since the Marikana event, the gap between the SA-CDS spread, so South Africa's credit default swap spread, basically over US Treasuries, widened relative to the EM peer group. So the two things that are reflecting the discount would be the currency, the rand, and then also basically your external funding costs, so what government would have to pay in addition to actually raise money in the offshore markets. The other factors that we have considered here would be your housing market. So you can basically see the little pink line, so it's okay, it comes up quite lightly. But the local residential market, so based on the house price index, has not faced a penalty. It's risen by about 25% in nominal terms since the beginning of 2012, so that's roughly 7% per year, which translates into about 1.5% real growth. Slightly short of the average 2% real growth we've had, but not too bad in the context of a highly indebted consumer. So that just puts the economy into perspective. So obviously Greece taking a lot of strain, Turkey and Brazil facing potential overheating in their property markets. On the right-hand side, you can then see capital flow. So we as economists fret a lot about capital flows. It's sort of partly our bread and butter on a day-to-day basis because it will determine where equity markets will go, where bond yields will go, where the rand goes. And you can basically see that yes, in 2013, so we had the downgrade start in 2012, we had a weakening in capital flows in 2013, and that was partly due to the taper tantrum. So it wasn't necessarily explicitly due to the sovereign ratings risks related to South Africa, but it does highlight that South Africa is often seen as a vulnerable credit. So it is on the risky list, alongside Russia, Brazil, Turkey, and therefore it's known as sort of high beta plays, and when things go pear-shaped, there will be a penalty via capital flows. We think if we do lose investment grade status, that will warrant or trigger capital flight, which will then very likely precipitate a recession. So trying to be all bubbly about a potential recession. In terms of the invisible cost of the downgrade, so this is always the one that is possibly the most sensitive one to broach, particularly with policymakers, and that's to say the private sector is not investing and it's not hiring, and this is where we're bearing the cost of the downgrades. So I know it's a busy chart, but basically what you have in the orange line is private sector fixed investment growth in real terms. In the blue, that's the RMB-BR Business Confidence Index, and then the green is from the BR Manufacturing Survey, which rates rating of political risk as a constraint on demand. So you can basically see usually a positive correlation between business confidence and private sector fixed investment, which is quite obvious. So again, very alarming that the business confidence index has been sub 50 for the most part in the post-crisis period, which also means that we've actually had a recession in private sector fixed investment. And then if you look at the rating of political risk, it's inversely correlated with private sector fixed investment, and the political risk has over the last 3 to 4 years most often been the biggest constraint on demand. So it's actually not the biggest constraint on the business environment. So it hasn't always been a lack of demand, which is what you would think would be the obvious reason when you're only managing to grow 2%, but rather it's the politics that is now weighing on private sector investment. The right-hand side chart just makes the point specifically, if you look at the share of private sector investment in overall investment has been steadily declining. So again, companies locally are unfortunately not investing in SA because of the uncertainty associated with politics and policy, which is what's pressuring the rating. So obviously, given the importance of the agency, so Owen was remarking earlier to me that the ratings agencies actually have a lot of control and hold a lot of sway of the future of some of these economies, and rightly so. So SA certainly, we're in that boat. So if you look at the services that credit rating agencies provide, so the first one is an information service. So in many countries, what they do is they basically reduce the information asymmetry between the borrower, in this case it would be the government, and the lender, investors, retail investors, professional investors, offshore investors. In SA, that's probably less relevant because our government is actually quite transparent. So if you look at all the budget transparency metrics, whether it's with the World Bank, the World Economic Forum, SA usually scores in the top 10 on transparency. The next one is certification service. So this is just a nice way of saying that you basically have the rating features in either regulation. So if you think of Basel II and Basel III, so you have to be of a certain rating for banks to own your bonds, etc., or then the index exclusion or inclusion. So with this, you have basically global bond indices, for example, the JP Morgan bond indices or the Citigroup World Government bond indices. And often what you have is the rating determines whether a country is in or out, or whether foreigners will buy your bonds or not. This is very important for SA because one, we closely adhere to Basel regulations, and two, we're a big weight in JP Morgan's indices and also quite a big weight, or we're a feature country in terms of the Citigroup World Government Bond Index. So the fact that we are investment grade has allowed foreign investors to own our bonds. So foreign investors now own 35% of South Africa's government bonds versus 14% about 6-7 years ago. So that's significant. The other one is obviously the monitoring service. So this is the idea of sort of carrot versus stick. So the monitoring service you would think would be that combination where a rating agency can actually have sway over government. So it's almost like the IMF giving government advice. Similarly, a ratings agency who say, yes, you're doing this well, that you're doing badly. But obviously in SA, we have found, certainly in our discussions with government, as well as with the ratings agencies, there's not quite that influence that ratings agencies could have when it comes to the SA situation. So that's arguably less relevant. Why do we look? So there is something ridiculous like 95 credit ratings agencies globally, so take your pick. The reason we look at what's called the big three, so S&P, Moody's, and Fitch, is that they basically cover 95% of the market. So they rate around 130 sovereigns. And then also what we've done is to actually look at which of the ratings agencies are most successful. So ratings agencies aren't all equal. So you can see just in the top table there, what we do is basically we've looked at various literature, looking at accuracy, timing, and then stability. Because these are important. One, you want a rating agency to, in a timely manner, tell you that you are going to be downgraded, or rather you are going to be in a position that's akin to a downgrade, or that you're going to default. But obviously you don't want ratings agencies to be erratic, because when it comes to sovereign ratings, they basically cap what any other company in the country or bank in the country can be rated at. And if that's quite volatile, it implies companies will face significant volatility in terms of their funding costs. And we found, based on the literature, that basically your S&P and Moody's are the better. Certainly S&P in terms of short-term timeliness, in terms of downgrades and upgrades. And remember, S&P has South Africa at BBB-, which is one notch above junk status, and then Moody's tends to score well on stability. We tend not to focus too much on Fitch, given that they score sort of third out of the three. So I know it's quite a busy slide, but what we've done here is just to highlight what the big issues are that the current rating, or that the ratings agencies are looking at with regard to SA. So broadly, you've got basically, let's say, 4 categories. One would be the strength of your institutions. So SA is neutral to high on low, so budget transparency, the South African Reserve Bank's independent, inflation targeting, independence of the judiciary, protection of private property rights, all those seemingly soft and fluffy issues are very important. Then we've got the economic score, so employment growth, economic growth, etc. There, South Africa is neutral, but the trend has been negative. Then we've got the external score, so that basically says how vulnerable is the economy to exogenous shocks. So I'm sure you've read in the paper about the current account deficit, so that's the big baddie for the currency. And because SA has a very large current account deficit, so it's basically importing a lot more than it is exporting, it is seen as vulnerable in terms of the external score as a weakness, and then finally, and importantly, the fiscal score. So what's the fiscal position doing in terms of the budget balance, the debt ratio, future revenue growth, and basically all-round fiscal sustainability. And on that score, it's generally seen midway to a weakness. In terms of, so basically, that just highlights the four broad themes. So just keep these in mind, because what I do later is to actually compare them to our peer group. So you can see just how do we get to the peer group. So we know South Africa is rated BBB- by S&P. So similar ratings are given to Brazil and India. Then we've got Russia, Turkey, and Indonesia in sub-investment grade, and BB+, and Philippines on BBB, Mexico, and then South Korea. So often people think South Korea is an SA peer group, but actually it's not. It's actually doing much better than we are, and we shouldn't really be comparing ourselves. So this is what we think the peer group is. Really, we call them the suspect six. So South Africa, Brazil, India, Russia, Turkey, Indonesia. So I know it's quite a busy slide, but just to make the points about the peer comparison. So the top left-hand slide, which is the World Bank governance indicator. So basically, these are the soft issues that we don't really see and feel, but that are very important if you actually think about the confidence that it can or cannot create. So if we look at, for example, so basically, thinking about sort of strength of institutions, voice and accountability, protection of property, private property rights, etc., we actually score really very well. So when you tell people we actually rank highest of the peer group in government effectiveness, they really look at you with disbelief, because obviously the water's not working, we have load shedding, etc. But it's all a relative game. And we think these soft issues, so the fact that the judiciary is independent, these issues are what are keeping SA in investment grade. So if anything were to tinker with that, then we'd be really worried. So again, if you think about the expropriation bill, the Mineral Resource Amendment Bill, Labour Amendment Bill, all of that would be red flags with regard to the factors that are actually pulling us into investment grade. Whereas you look at sort of what we call sort of the quantitative factors, so more of the hard numbers, growth, inflation, debt ratios, that's where we are looking less favorably. So again, if we look at government debt to GDP, relatively high, currently sitting at about 47% of GDP. That's up from around 28% 5-6 years ago, so it's a significant increase. Not nearly as alarming as Brazil. Brazil's at 64%, but still, we've had a significant increase, and this is one of the factors that is a potential threat. Then also, as I mentioned, the current account balance, bottom left-hand side, it is very big and very sticky. So despite the fact that we're actually slowing down in terms of the economic growth, we continue to import goods from offshore. We haven't made locomotives for many years. We are aiming to make them now, but the infrastructure rollout we've had has forced us to up our import bill. We're saving a little bit of oil, but that's not offsetting the fact that we're actually getting less earnings if you look at the gold price, the platinum price. So that's our big vulnerability. And then here is our growth rate. So SA's growth rate pre-crisis was in line roughly with the EM trend. Okay, so pre-crisis, we were an emerging market when it comes to growth. Post-crisis, we're very much like a developed market. So that's also the oddity of actually doing any analysis or dealing with SA is we've got emerging market characteristics and developed market characteristics. Unfortunately, when it comes to growth, we're a developed market, yet we face EM unemployment. So these two, the inability of these two to actually meet is also what's a pressure point in terms of the rating. So do ratings matter? Yes, we think they matter, but obviously it's a challenge to convince people that they do. It's important to know that an investment grade status reduces the funding costs for a sovereign by 36% more than just dictated to by fundamentals. So there is a seal of approval in having that investment grade rating and a tangible benefit in terms of what you pay for the money you have to borrow. I've listed there the main impacts or channels via which a sub-investment grade event or trigger event would impact the economy, and they're quite obvious. Financial markets, funding spreads, so recall that CDS chart, foreign capital flows, and then sentiment. So arguably, we haven't seen the hit yet to foreign capital flows, but we have felt it in sentiment. We've seen it partially in funding spreads, and if you look at the currency, we have seen it in some of the financial markets. Obviously, the key issue would be whether we go into a virtuous or a vicious cycle. So the weaker the growth, the weaker commodity prices, the less effective government becomes, the risk of a downgrade, the weaker the sentiment, the weaker the growth, and it's just a vicious cycle, versus actually starting to address some of the shortfalls may actually reverse that. And we think we do have time, but not much. So we think to end of 2017 is when our time would have run out. So if we don't reverse course by then, we'll probably be junk status. So these are sort of the key factors, and again, sort of the feedback loop. So those would be Eskom, obviously. If we can sort out Eskom, a lot of our problems would go away. The NDP stands for the National Development Plan. Not sure if everybody knows about it, but the National Development Plan is basically government's very big, ambitious plan to get the economy growing in an inclusive manner, commodity prices, and then socio-political tensions. Those are obviously all linked. Okay? Load shedding reduces sentiment, investment, etc. Weak commodity prices, the combination reduces employability or employment. Lack of education reduces employability, and therefore we have socio-political tensions, which again depress sentiment. So this then feeds to the business investment climate, willingness to spend, willingness to increase capex, and fiscal sustainability via revenues. If those two are questioned, then obviously that has a knock-on to foreign investors. And remember, foreign investors have to fund our current account deficit. If we don't fund the current account deficit, it goes all the way back to weak confidence. So that's why it's very important to deal with these things like Eskom. How are we going to deal with a weak commodity price backdrop? So certainly our view is that commodity prices will not recover within the next 3 years. And therefore growth is unlikely to move much, say above 2 to 2.5%. If we then look just at some of the case studies, so this is obviously very important because, you could look at, say, I've listed some of the examples, but let's say, you want to look at a country that has lost investment grade status, such as Hungary, and think, but Hungary is not doing too badly. The issue is obviously that the average time from peak to trough rating, or peak to the loss of investment grade rating is only 8 months. So it happens very, very quickly. Because if you look at the average time it takes to get back into investment grade is 7 years. Okay, so if we lose investment grade status within the next year and a half, it's going to take us another 7 years on average to get back. So, by 2025, we'll probably be back in investment grade, but with a significant cost to the economy. What we've done is also to do a study just on the impact of the loss of investment grade. And generally, you have weaker growth, a weaker currency. You can either have high inflation because of the currency impact or low inflation because of the output gap, but that's not good low inflation, that's bad low inflation. And then usually your policy rate is lower. So your policymakers are incentivized to actually bail out growth, and therefore it's a race to the bottom. So you end up with a weak economy, no ammunition to support the economy because you've spent it all during the time that investment grade was lost. Then finally, I know again busy charts, but what we do here is so the key issue or the vulnerability we think is if we were to lose investment grade status, we think we'll face foreign capital flight. So all those people who've been buying our equities and buying our bonds will actually sell out of SA, which means your rand will tank and will have a knock-on effect to the economy via a recession and high inflation. What we've done here is just to look, for example, at real GDP growth. So the shaded areas are times of capital flight, and you can see each time capital flight, there's a substantial capital flight, the economy goes into recession. So we think there's a high likelihood that the economy will enter recession. Your inflation outcome is mixed. In the end, it's bad disinflation or bad inflation. Either way, it will be costly to your consumer. and then usually the housing market tax. So again, knock-on effect by the wealth effect to your consumer. So with the consumer being 65% of SA's gross domestic product, this is obviously a key vulnerability to the consumer. So it's not all doom and gloom, because obviously, this is very much from a Western perspective, given that the 3 credit ratings agencies sit in the West. So you can see on the left-hand side, I've listed some alternatives. So we've got the BRICS Bank, so it's called now the New Development Bank. So they currently have about $50 billion in capital, which will lift to about $100 billion. So we do have alternative sources during times of liquidity crunch. Then there's also the Asian Infrastructure Bank. They've also started to do quite a lot of work in Africa, and that's also a potential source of funding. The Reserve Bank has, for example, signed various liquidity agreements with, for example, the Chinese Central Bank. And then we also have IMF reform, so a bigger role of emerging markets within the IMF. So I wouldn't say it's all doom and gloom, but again, once we're in the position where we actually have to call on these alternative sources, it means things have already gone pear-shaped. Just to conclude also why it's very important to focus on the credit ratings agencies from a Western perspective is the fact that if you look at the countries that, the investors domiciled in the countries that own the largest share of SA portfolio investments, so basically stocks and equities, and then I've also listed specifically government bonds. You can basically see US, UK, Belgium. They're not going to be too worried about what Chinese rating agency thinks of SA. What they're worried about is what S&P thinks, what Moody's thinks, what Fitch thinks. So this is always the challenge of convincing specifically policymakers to say, actually it does matter what the big 3 thinks, and therefore you have to actually take heed of their, call it, advice in inverted commas. And that's it. I don't know if I should open to questions.
Yes, ma'am.
Okay.
Any economist volunteers to open to questions?
Well, I've got 2 hands and not all the answers.
Fantastic. I have a question all the way from the back from Scott then.
I'm always fascinated, there's lots of scenarios, but what do you suggest in simple terms we should do in the next 5 years as individuals, based on the facts here?
Okay, so that's obviously a very important issue because we focus on it a lot from sort of a top-down policymaker perspective. I think certainly from an individual perspective would be to take ownership of your choices. So that certainly enters into sort of the corruption angle. So the World Bank governance indicators, the one area where we do fall or have started to fall short is on sort of the corruption metrics and perception of corruption. So I think from an individual perspective it would be to actually to name and shame, to not take part in corruption. That would be the big one. So I think there are definitely, people that that would pay out bribes at a traffic, at a roadblock and things like that. So that would be one of the obvious starting points. And then also I think the idea to community upliftment, so to make people around you less reliant on government, because I think that's also something that's come with an increased government in the economy is the fact that a lot more people have become reliant on government and not on the private sector. So I think to the extent that we can support entrepreneurs, etc., we should do so rather than taking the quick way to big conglomerates, etc. So not against, I work for a big bank, I love big banks, but so I think it's really to sort of that idea of passing it on within the community. So anti-corruption and uplifting your own community.
A quick question from me is, I've seen the weak oil price being our escape route. We could have got a lot worse, a lot faster because it's such a major input for us. Where do you see the oil price now that we're where we are right now, the $50 mark? Do we move far off that? Because if we've got a weakening rand and a strengthening oil price, the double whammy is going to hit quite hard.
So obviously, luckily I don't have to do our currency forecast, and I also don't have to do the oil price forecast because I think I'd be a better weather person than forecasting the rand or oil. But I think generally our view is that we'll probably stabilize at current levels. There could be very slight upward pressure for various reasons, but I mean we don't see oil going back to the 80s, 90s, 100s. Obviously, your scenario is quite a unique one where the rand tanks and oil moves higher. That would probably be very SA specific because generally if oil is moving upwards, other than geopolitical risks, other commodity prices should also be moving higher. So the rand would then be okay. But where we are at the moment, so the problem, so we've had a benefit of low oil, yes, but if you think about it, you can't prosper by saving money, right? So you actually, if you do better when you sell more at a higher price than you do by consuming less or at a lower price. So I think we are having that benefit of the low oil price, and it is helping the current account balance. It has led to a bit of a saving for consumers via low petrol costs, but the good news is in the base. So we won't benefit anymore, even if oil falls on Brent to something like $40 a barrel. And then the risk we would have to watch is the fact that so far your low oils offset your rand weakness, but obviously if you actually have oil booming for geopolitical reasons or oil-specific supply reasons, yes, inflation is going to be higher, the consumer is going to be more squeezed, central bank's going to be in a very tough spot because there's no demand, but inflation is running through the roof. Yeah.
Carmen, there's a few examples of what happened to interest rates where a country was derated to jump.
Okay, so in the study we did look at, okay, so the interest rate story, usually what you find is so it can happen together or after, but usually a sub-investment grade trigger is associated with sharp weakening in the currency. The sharp weakening in the currency may lead to the central bank hiking rates to protect the currency. Because if you recall, a lot of these studies, interesting about them is a lot of the emerging markets did not have inflation targeting at that time. So because they did not have inflation targeting, the central bank is not necessarily compelled to lift interest rates. And then the complicating factor of doing this on bond yield terms is that a lot of these countries did not have domestic bond markets at the time. But generally what you would find is that half the time short-term interest rates will move up sharply, other half of the time they will be cut aggressively to bail out the economy. So it is mixed. I would say bias would be initially significant hikes and then cuts, but generally your long-term interest rates spike. And they do fall again over time, but there is quite a big initial reaction. So overall, you end up with, in the immediate wake of sub-investment grade, a lot higher rates and a lot steeper yield curves. Obviously, that then has implications for the corporate sector in the economy.
I heard a collective gulp across the room. Any further questions? I'm going to take 2 questions.
You basically indicate and the probability to downgrade status as of the end of 2017, would it be 50-50 or what do you think?
It started so upbeat. Yeah. Look, I mean, certainly my communications to my internal stakeholders and clients is that you would be best served to prepare as a base case for junk status. So obviously making use of opportunities, that doesn't mean sell out completely because again there will be opportunities. So if you think about the whole point Scott made, because you're in this economy, there will still be money to be made, but I suppose how you position your business may need to be tweaked. You may source your funding from elsewhere. So so again, yes, we should fear judge status for various reasons. That doesn't mean it's without opportunity, but I think it would be imprudent to dismiss the possibility if you look at it from sort of a risk management perspective.
You spoke earlier on about bonds.
Sorry.
Yeah.
I'm just saying, yeah, so...
You have to have a hedge on. Yeah.
You spoke earlier on about bonds. Can you comment about the impact that the liquidity squeeze is going to have on the property market and funding of the property market in particular over the next couple of years?
Okay. So yeah, so Basel has been, at times it's quite difficult to quantify. And certainly when you speak to policymakers, I think they would share our assessment that a lot of the tightening has already happened. Okay. So if you actually look at your effective prime rate now versus your pre-crisis, so, you know, various studies give various estimates, but you could say something like the implementation of Basel locally, which is actually quite far advanced. So for the little emerging market that we are, we're always right in front when it comes to implementing banking sector regulation, is that it's been equivalent to a 100 basis point repo rate hike. So we think a lot of the impact of Basel is already taking place and therefore should already be filtering through the property market, and we don't think there'll be as significant a future squeeze over the next, say, 3 to 5 years, unless they introduce new strict regulation. But I mean, our banks fare very well on all the capital adequacy ratios, etc. There are some of the ratios where, for market structure reasons, they can't implement it, but we doubt that will be a limiting factor on the property market.
Okay, I can sense in the room the one question that wasn't asked, and I was hoping it was going to come from the floor, is not about the World Cup, not about rugby World Cup, but could you give us a house view, so not putting you on the spot, a house view on the rand, exchange rate, and interest rates for the year?
Okay, so yeah, so on the rand, we're actually quite bullish and optimistic, and we think it'll end the year at 12, which every day seems further and further away. But yeah, so again, various reasons. We think the current account deficit will improve capital flows will be there. For example, we don't think the Fed's going to hike aggressively. We think they will hike, but not aggressively. And therefore, demand for yield will still be there, so reasonably optimistic on the currency, also reasonably optimistic on the interest rate cycle. So we think the Reserve Bank might hike one more time, and then be done. Flip side to that is obviously that we think there's a meaningful risk the economy could enter recession, and therefore the Reserve Bank may be forced to reverse some of the hikes. But we think, yeah, so we think repo rate will peak around 6.25%, and bond yields will actually fare quite well in an environment of subdued growth and no inflation problem.
Comment, please. Thank you so much.